the Moneyweb Crypto Podcast, where we discuss all things crypto related. Your host, Kieran Ryan.
Here are some sobering stats about Africa. Just 3% of people have access to mortgage funding so they can own and build their own houses. This is why, when you travel across the continent, you see thousands of partially built homes waiting for the next bit of cash to add a wall or a roof. This is also why it can take a decade or more to complete a home paid for in cash. And here's another sobering stat. 40% of people in Africa will hit a financial wobble in any 12-month period. Is there any better way to finance homes than the old cash drip method? Anyone owning a home in South Africa can understand the hazards of mortgage financing. Missed 2 payments and the lawyers are all over you. And then you're in the court system where the consumer seldom wins. Banks' lawyers are not averse to using underhanded tactics such as inflating arrears with unauthorized legal fees and refusing to provide a proper accounting for how the arrears are calculated. One company using the blockchain to upend this model is Empowa, which came out of nowhere, matching investors and borrowers with an interesting model that provides access for millions of people who would otherwise not qualify for mortgage finance. Without further ado, let's welcome Glen Jordan, who is the founder of Empowa. Hi, Glen. We spoke about a year ago, and we said at the time that we would get in touch again to get an update on what's been happening with Empowa, and a lot has happened since then. For those who missed that podcast, explain what Empowa does and what problem it's trying to solve.
Yeah, thanks, Kieran. Nice to chat again, and yeah, good to chat a year after, and good to know we're still around, which is always good in the startup world. So really what we're trying to address, Kieran, is exactly as you've outlined, the challenge around affordable finance for housing. And the biggest challenge that we have is that more than 80% of income in Africa and across the developing world is informal. By informal, we mean there's no formal record of it. It doesn't come in a standard way, so it's not a monthly income. And therefore, what happens is, due to that informality, exactly as you are outlining, nobody qualifies for, or very few people qualify for a mortgage. Without a mortgage, just as you've outlined, there's no access to housing, which means that the vast majority of Africa and the developing world lives in substandard housing. And that's not a function of poverty. That, I think, is the most important part. The immediate assumption is that it's a function of poverty, but it's not, because actually what we've discovered is that it is very, as in most things, it's expensive to be poor. So it ends up actually that most poor people pay more for their housing than you would if you had access to the formal financial system.
All right, so that's by way of introduction. Now, I did say that the blockchain plays a part in this. Just explain why the blockchain and how the blockchain ties into what you're doing.
Well, really, we use the blockchain at three distinct levels. And I think, again, one of the things we need to outline right up front is that the blockchain is not crypto. Crypto right now, all the press and everything is around Bitcoin and the speculation around that and the value of that. But actually, the key part around this is what's the underlying technology of the crypto space, and that's the blockchain technology. And the blockchain technology is very powerful from the perspective of being able to record timelessly, in a verified manner, financial transactions. So we use the blockchain with 3 levels. The first level is to record for the recording of transactions. So, as I say, it provides timeless, verified cash flow transactions. The second way that we use it is for the transfer of value. So if there is an opportunity to do so, we do use it to transfer value if and where possible, because that enables us to reduce costs. And the third layer that we're working on is actually at foreign currency risk. And that's a mechanism by which we're seeking to attract foreign capital into the space in a way that mitigates the foreign currency risk. And that's where this tool, again, might be useful.
I want to come back to the funding side of it in a minute. But before we get there, I see from your website that your business model says that 60% of people can now afford to finance a home through Empowa. as opposed to just 3% previously. That 3% is basically bank mortgage finance, I presume. I'd like to understand how that works. So what you have done, and I get this from your website as well, is people who don't have a pay slip every month, they don't have regular employment, but they might run a spaza shop, or they might even run a roadside fruit seller market. They might be selling door to door. They could now theoretically apply for finance through Empowa for a house. Am I correct?
That is correct. That is correct. So we're the technology layer that links capital to that market. So that's the process by which we do it. But we're opening that market to the financial institutions. That's correct.
And so are you competing with traditional banks in providing mortgage financing, or is it more of a partnership?
No, it's a partnership. To address this market, Kieran, there's a backlog of 50 million homes today in Africa. As you know, we have the youngest population in the world. We have a growing urban population. So that is a growth market. So we have a backlog of 50 million homes in a market that is growing. So our limitation here, and this is the irony, is it's not around people who can pay. That's what we're trying to highlight. It's not around people can't pay. It's that they don't have access to these mechanisms because the products don't fit the reality on the ground. So we are trying to support capital in whatever form and wherever it can come from in order to address this market. So if you can imagine, just to address the 50 million homes, that's more than $1 trillion that's going to be required, in the future. That's our constraint, not people or not opportunity.
Okay, we spoke a year ago, and one of the stats that came out of that particular podcast, which fascinated me, was Mozambique, which is a country with roughly 30 million people, has less than 1,000 mortgages. How are people in Mozambique building and living in houses?
Exactly as you said in your introduction, like mostly across Africa, via self-build or microloans. And the challenge of that, there are two major challenges. Obviously, we know microlending is expensive. It's not a cheap way to access money in any shape or form, and particularly for housing. So microlending is a costly way to build a home. And the other challenge with self-build is that in a city like Beira in Mozambique, when there was Cyclone Idai in 2019, more than 80% of the housing stock was lost. And as you can imagine, from a climate perspective, that's becoming more and more regular in Mozambique particularly, but across the continent. And when somebody loses their home because it hasn't been built according to proper standards, they lose everything. So from a financial and a climate resilience perspective, the impact of that is huge. It's significant because you don't just lose your home, you lose everything in your home. So you lose all your possessions, the damage that it's done to all your possessions. So it's really around how do we find a mechanism to provide possibility for people to have professionally built homes, as opposed to raising a bit of cash, as you highlighted in your introduction, and getting your brother-in-law to build a wall for you.
Right. So tell us how things are going with Empowa. You're in 8 countries, I understand. What's the pipeline looking like? What's the demand?
It's growing rapidly. And I think it's really quite exciting, Kieran, because for us, it's been a process of, as you can imagine, in the startup world, we're dealing with fintech. It's about building reputation, building credibility, and most importantly, building data. And that's really what's happening now. So across those 8 countries, we're building data. So we're building payment data, which has been invisible up until now. We know if you work in this environment, we all know that this is the reality, but we have no data to prove it. So just in our payment mechanisms, we have wonderful payment profiles now, data to demonstrate how people pay. And everybody has a unique payment profile. So, and what I mean by that is, for this process of a installment sale, basically what happens is you have a minimum payment that needs to be made, and then you can contribute as and when income comes in as the consumer. So what happens is, in the informal environment, as you know, you're in the hustle economy, you hustle daily. Just those examples you talked about, a fruit seller, a door-to-door salesman, or whatever business you're in, it doesn't function on a monthly basis. it functions daily generally. And so for people who contribute like that, whose income comes in maybe seasonally, in Beira, we've got fishermen, we've got security guards, you have people who have family in the diaspora. It means that income is intermittent. And just as you also outlined, people have challenges, they have financial challenges. And if you don't have significant savings, if you don't have savings, then those financial challenges, you need to deal with them immediately, which means by definition, you're under strain. So if we can take that into account while putting rules and regulations that have to meet capital requirements in place, but really take into account the needs of the consumer, we can match both sides in such a way that it works. And that's what we're starting to find. I think the challenge of affordable housing is becoming such a political hot potato across the continent, across the world, is that people are desperately looking for solutions. And as we build this data and as we build this ongoing proof and scaling that proof, people are getting more and more excited about this opportunity.
And what are the 8 countries? Are you in South Africa? I know you're in Mozambique.
Yes, we are in South Africa. We're working with some developers in South Africa. I think it's a growing opportunity, but due to the level of sophistication of our banking sector, it's less of an urgency, if you like, in South Africa, although we see it growing and we've seen the demand growing from that perspective as well.
And the other countries, what are they?
So we're in Kenya, Uganda, Zimbabwe, South Africa, Mozambique, Nigeria, Morocco,
Ghana.
That's it. Ghana. Actually, 9 now.
9 countries.
9 countries, yeah.
Wow. Okay. Now, let's get back to this point about investors. You're not using the traditional banking model. You're using something quite different. Are investors biting on this concept, and how do you convince them that this is a risk worth taking, given the potential for default when, as I said in the beginning, 40% of people in Africa will hit a financial wobble in any 12-month period. And that probably means the potential for default is quite high with this type of lending.
Well, Kieran, that's the really, really interesting thing. Because while resilience is low, for this type of expense or demand, actually the risk is low. And that's the irony of this market. So, even during COVID in South Africa, we found that the backyard rental market default rate was significantly lower than that in the middle class. And so there is this perception of this risk around that. And it's actually not valid, because people in this market segment, if you give an opportunity like this to be able to own your own home, it's what everybody desires. Everybody desires their own home. And if you have the opportunity and access to a mechanism that gives you that opportunity for the first time in your life, you will do everything that you can to ensure that you don't lose it. And that's what we're finding. So the irony, it's really around managing the risk. And that's the key part. So what we found is that the capital providers, by doing an installment sale, actually you have very little risk, because at the end of the day, you have the asset itself. More importantly, what we're finding is that you actually have the income stream. So if you secure the income stream, that by that mechanism, you are secured from a financial perspective. And I mean, Capitec is a great example of the growth market in that, being able to secure that. So it's unsecured lending, but you're securing an income stream, not an asset. So it's not asset-based. But if you have the asset as well, you secure the income, and you have a deposit, it's actually just treated like a normal rental or lease agreement. So if what you're doing is allowing that flexibility of payment, but you're managing it, and if you have the systems with which to manage that effectively, what you're able to do is significantly reduce that risk, because you have a deposit, you have that asset, you have the secured income. It actually becomes very low risk. And the irony is, in Kenya, for example, the increase in value of the asset has been 35% over the last 12 months in some of the developments that we're working on. So, to talk about risk, ironically, it's incredibly low risk because of this pent-up demand, because of this mechanism by which people pay, and because we find actually that this market segment does pay and actually often pays better than the traditional, what we think of as the middle class. And the basis of that is to provide the mechanisms to prove that. That's what we're seeking to do, is the data that we're building now and the systems prove that. And that's the key part around it, because before we talked about it and we had stories about it, but we didn't have data. And that's what we're now being able to prove.
Okay, so explain, what do you do in the case of default? How soon do you start chasing up people for missed payments? In South Africa, it's 2 months typically in the banking system, and they have a sort of a tiered approach to chasing up missed payments. They'll send you a letter of demand, and eventually you'll get a Section 129 letter in terms of the National Credit Act, which is a precursor to legal action. The legal action can take years, but it's an expensive process. And once you are in default with the banks, you're always kind of in arrears. You're always chasing your tail. How do you handle that? How quickly are you able to get on top of people who are missing payments?
So again, we're just the technology layer. So it's actually the property manager who is responsible for that. But they manage that as they would a normal lease. So if you can imagine, it's almost a mix of a lease agreement combined with an access, what the old days we used to call an access bond, where you were able to contribute ahead of it. So you actually only fall into arrears when you fall behind on the capital contributions that you've committed to. So if you're ahead of the curve, which we find people get way ahead of, because in fact we're finding that the repayment profile tends to be between 7 to 10 years, as opposed to the mortgage. You're actually ahead of that curve. So what you're doing then is you're building up, like you would have in the old access bond, is you're building up a bit of a reserve so that you've got time and space with which to make those payments. So that's the key part around it. If you then fall behind on that process, then there's an early warnings mechanism to highlight that, and then to try and find a mechanism to resolve that. And if that isn't resolvable, then it's a standard lease. So then, you're in default of your lease agreement, then the same process, applies to moving somebody out and moving somebody else in.
It's interesting that you say the repayment profile is between 7 and 10 years. There's been a lot of discussion about that in South Africa. If you can pay off a car within 5 or 7 years, why couldn't you do the same with a house? Of course, it depends on affordability.
Yep.
But it sounds like, well, from what you're saying, that this is actually the reality in Africa. People are able to pay off these debts much quicker than the traditional mortgage.
Well, I always use the example. There's a wonderful example. Where people talk about the salary of a policeman in an African country as a level of affordability. Now, the reality of income is such that we know that there are other sources of income. It's not just the salary for most people in this market. So to look just at salary for affordability it's incorrect. It's as simple as that, actually, because most people have multiple sources of income. And again, it's to look at it also as a family unit as opposed to an individual. Again, our financial systems are very individualistic and look at the one person, whereas often it's about family units living together, contributing, and then collaborating to make sure that particularly in the housing environment, that their home is an asset to which everybody's contributing. And that part also, it makes it far more effective. And that's why, as I say, you have various different income sources and different payment profiles, which are just fascinating to see how people pay and how and when they contribute.
It sounds a bit like what you're doing is securitization, what the banks would call securitization, where you have an income stream, you bundle that together into a kind of a bond which can then be traded. Is that right? There are some controversies, of course, around securitization and who actually owns that income stream and who owns the underlying assets, the houses. But maybe just address that one.
I wouldn't call it securitization because that implies, as you say, bundling things together. Actually, we're taking it down to a micro level where you're taking it and you're saying, what we're doing is we're just understanding that income is intermittent and therefore the income stream is intermittent, and you're taking that into account as opposed to trying to smooth it. Obviously, as you collate this and put this at scale, that possibility might exist. But at the micro level, what you're doing is you're saying, we know that the consumer who doesn't earn a salary doesn't know their income, and their income is variable. Therefore, how do we provide a system that accounts for that and supports that, while making sure that we de-risk it for the capital provider in such a way that they can still manage their returns and manage their risk. And that's the process of putting those together into a platform. And if you can integrate that in effectively through the technology, you're able to manage that process effectively. Now, one of the questions you asked earlier around the blockchain, also that can also happen in the terms of digital assets and ownership. And that's what we're seeing emerging. It's still very early days in terms of that process, but that's one of the reasons why we started building on the new technologies, because we see that as a mechanism for it to start happening. Because in Europe, I have the MiCA Act now, which is around managing this kind of process and digital assets being representations of real world assets. And again, it's part of what we're building, because this kind of technology will support that process very effectively in terms of reducing the cost of transfer, partial ownerships, and getting to addressing all of those issues. So rather than securitization and grouping things together, we're actually able to take it down to more granular levels and be able to manage this at a granular level for the consumer, while then collating it and being able to manage it for the capital provider as well. But it's actually being able to manage it effectively at the micro level that creates the power of the solution.
All right. This is the final question. What's the future like? I mean, if you project forward 5 years, give us a sense of how many loans you think you will have extended to the African homeowner. And will this also be used for other forms of lease payments? For example, people who want to acquire cars or, physical assets of that kind, maybe tractors, for farmers.
To answer your first question, our objective is to impact a million families by 2030. That's our big, hairy, audacious goal at Empowa, and we're driving that process really hard. And if we've done that, we've addressed a whopping 2% of the current backlog. So that gives you a sense of the scale and opportunity in this market.
Is that achievable, that 1 million families?
Absolutely.
Target?
Absolutely. That's a function. The demand is there. That's absolutely achievable. The demand is there. For us, it's a mechanism of encouraging capital to invest into it. That's our biggest. The constraint, as I say, is capital. That's our biggest constraint, is attracting the capital into the space.
Right. Now you've built up a little bit of data history, so you can actually go to investors and you show, well, this is the profile of our customers, and presumably you're able to give them some comfort.
Exactly. That's exactly it. We're de-risking it on a daily basis by building more and more data and building more and more case studies to demonstrate that this market, just as the question you ask, it's not as risky as it's perceived to be, that this does provide a financial return, a market-based return, that this capital can be used both to do good and to provide returns, to de-risk from a social perspective and de-risk it from a financial perspective. So that's the joy of what's doing. So we've seen it build momentum. The more data we build, the more case studies we have, the more it builds. And that's why we believe that it is possible to achieve that objective. This is really the kind of opportunity where there will be growth on a sort of, they always use the hockey stick methodology, but in this case, it's definitely possible to grow it at with that kind of profile, the hockey stick kind of profile.
Fascinating stuff. We're going to leave it there. Glen, thanks very much for joining us. That was Glen Jordan, who is the founder of Empowa. And I guess we're going to have to check in with you, probably not in a year's time, but a little bit sooner. I'm quite excited to hear about your growth prospects And I do see this as a challenge to traditional banking, and I'd love to find out from you how it's going in the next few months. Thanks very much, Glen.
Great, Kieran. Always available. Love to chat.
Thanks for listening to the Moneyweb Crypto Podcast, hosted by Kieran Ryan. To listen to our other podcasts, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates.